Well, folks, the government is going after crypto. Coinbase was just issued a Wells notice from the SEC, which is essentially the idea they could be facing legal threat from the government if they don't comply with what the SEC has laid out. But this is where things get really interesting because the SEC has not laid out a clear plan on what is considered a security in the crypto space. I'll be honest, I think this is a publicity stunt from the SEC to raise awareness around crypto and act like they know what they're talking about. Historically, the SEC has been very difficult to communicate. It's been more than 2 years since Coinbase went public, and back then in 2021, the SEC did not file any legislation against the company for what they were listing on their exchange. But all of a sudden, it seems like the government has changed their mind on what is a crypto and what is a stablecoin, which is exactly what is leading to the repercussions that Coinbase is facing today. Whether or not this is to be considered a serious headwind for the crypto industry, I'll let you guys decide that for yourself. But in this video, I want to give you guys an overview of what exactly this litigation means for Coinbase stock, its business, and also cover some of the insider trading acquisitions that the CEO of the company has faced very recently. But as usual, guys, before we get into it, make sure to drop me a thumbs up and hit the subscribe button if you haven't already. So to start things off, I think it's really important that we put some context into what's been going on in the crypto industry. Just yesterday, we learned that Lindsay Lohan, Jake Paul, Lil Yachty, and some other YouTubers were convicted by the SEC for boosting crypto. This is obviously a pump and dump scheme where these influencers were paid by crypto firms like FTX or brokers to pump their specific altcoins, stablecoins, and crypto tokens, which resulted in many retail investors losing money. Now, the really interesting thing is that all these influencers can pay the SEC a $400,000 fine to settle the charges without admitting or denying the SEC's findings. And since the SEC stands for the Securities and Exchange Commission, why are they concerned with what's been going on in the cryptocurrency space if they don't consider cryptos to be a name book security? This is obviously what Coinbase wants to learn from the SEC, but they haven't been able to get clear legislation on that, which is really creating this double-sided knife around what Coinbase is trying to do. When Coinbase went public in April of 2021, they filed a very detailed S-1 prospectus for their IPO, which the SEC audited and reviewed. In that prospectus, they outlined exactly the securities that they allowed to be traded on their broker and exchange, and whether or not the SEC could consider them securities. The SEC did not provide any insight on whether or not Coinbase was right with their analysis. Instead, now, 2 years later, Coinbase is being faced with litigation from the SEC that they did not comply with the right regulations, where the regulations did not even exist. But to be honest, I'm not angry at the situation. As somebody who believes in the long-term opportunity of the blockchain, I think this is actually a good thing for the overall investment community. At some point, we needed the SEC to kind of show us that they are indeed just a bunch of clowns that don't understand what cryptocurrencies are about, and that is exactly what we're facing today. Coinbase is going to be at the forefront of this because they're the only US regulated publicly traded exchange in the country. And obviously the companies are the forefront of what's happening in Washington, D.C. with their different prospectuses, court cases, and proposals to the government. Coinbase met with the SEC over 30 times over the last 9 months, but the SEC raised no concern about any of the assets on their platform, even if they had plenty of time to do so and warn the company about what they're trying to do. Instead, what the SEC has been doing is canceling some of the meetings held with Coinbase's top executives and saying that they're going to continue with their enforcement investigation against the company, when there's obviously very little information on what Coinbase is supposed to do if they want to be on the correct side of the legal battle. Out of more than 2,000 altcoins on the market, Coinbase only allows around 250 of them to trade on their platform. This means they have a very stringent vetting process to make sure they're bringing the right assets, the right blockchain, and the right holders onto their platform. Now, there could obviously be issues with this specific vetting process that the SEC is going after, or there could be problems with Coinbase's staking service, which currently accounts for only less than 8% of their total revenue. And what's really funny is that if the SEC does decide that some assets in the crypto world are considered securities, the real people at fault are the asset issuers, not an exchange like Coinbase. Coinbase will most likely just be handed a fine around maybe, let's say, $100 billion to comply with the settlement. And then the asset issuers are the ones that are actually going to go to court to deal with all the repercussions of their specific play. And that is exactly what Brian Armstrong, the CEO of Coinbase, recently outlined in an interview where he said he does believe that Coinbase is going to face legal litigation from the SEC because of just how unpredictable their governance and vetting process is. Now, obviously, the big question on everybody's mind is how is this going to affect Coinbase stock and its business? On the surface, it looks like this SEC enforcement is a pretty big deal because obviously we had so many scams uncovered over the past 12 months in this massive bear market, including FTX. But again, the difference with Coinbase is that it is a publicly traded company, meaning most of its financial data is already available to every single investor to read and understand. The real issue Coinbase will most likely face is potentially a fine if it turns out that their staking services are not compliant with what the SEC wants, or they're listing some assets that are considered technical securities. In that case, we could estimate what the fine Coinbase could be facing, which I guess would be around $80 to $100 million, which is a complete guesstimate based off what Kraken faced with its Paxos and related crypto staking scandal earlier this year. If Coinbase's staking services were to be shut down, it wouldn't cause a massive deterioration to the company's long-term growth prospects because it accounts only for an 8% of the company's current revenue. The company has plenty of R&D and investments currently going on in the wallet, decentralized Web3 and NFT space to overcome some of the implications of that specific scenario. And even with some of the debts the company is currently holding, they have cash and cash equivalents of around $5 billion on their balance sheet and a current ratio of more than 7. But what about the insider trading acquisitions that we are seeing against Coinbase and Brian Armstrong? Well, turns out it's not as big of a deal as many people are making it out to be on social media, and here's why. Yes, it's never a good sign to see the CEO of a company sell stock in his company instead of buying stock. But it's important to keep in mind that Coinbase was one of the biggest venture-backed companies to go public in 2021, meaning Brian Armstrong already had a massive stake of more than 2% in his company, which he had to unload to make sure he is not concentrating too much into just one sector. Now, whether or not you should be able to sell so much stock worth more than $50 million in the span of 5 months, I don't know. But that is just how the US economic and capitalist system works, so let's just leave it that way. Instead, let's try to understand why Brian Armstrong sold and when he sold and how that will affect Coinbase's future prospects, which in my opinion will have a very minimal effect. As you can see, Brian sold stock in the company not before the collapse of the crypto bear market, but actually after the collapse, meaning most of the selling that he's doing is at a price that is much lower than at what prices the stock was trading at over 12 months ago. After the IPO in April 2021, most of the sales started in the fourth quarter of 2022. And it looks like, based on the pattern we're seeing, that this is most likely a part of a 10-5B plan from the SEC, which is essentially a plan that the company outlines for its executives to sell stock over a predetermined amount of time on a predetermined amount of quantity. And as a matter of fact, that is exactly what Brian Armstrong has been doing. As you can see, the number of shares total that he technically owns are always zero whenever there is a line item that consider him as the insider trading. That is because this is a part of his supposed retirement plan where he's consistently selling stock in his company and potentially not getting accused of insider trading, because obviously this is an automatic plan. The price, amount, and sales dates are always outlined before from the executive selling and the broker through which the sale is occurring. That is a part of the 10b5-1 plan, which is something many executives right after IPO tend to do. And it seems like so far the CEO of the company is doing exactly that. As a matter of fact, if you look at anybody else other than the CEO, there is actually a net buying going on in Coinbase stock. A lot of executives and directors were granted a lot of stocks through options exercises in the middle of February, right before the company reported earnings, and a lot of them actually ended up buying stock with their own cash when the stock was trading in the 30s and in the 50s. Shopify CEO, board member Tobias Lutke, and the co-founder of Coinbase, Fred Ursham, have been investing in this company aggressively over the past 12 months, even if their shares have continued to go down. And this is exactly what something like us retail investors should be trying to mimic, which is the idea of not paying attention to what the pricing does in the short term, but just focusing on the fundamentals of the business and the growth prospects. But as usual, guys, everything in this video is just my opinion, so let me know your thoughts down in the comment section below. Is this a time to sit on the sidelines, or is this more of an opportunity that maybe we should take advantage of? Let me know your thoughts down in the comment section below, and I'll catch you guys in the next one. Take care.